Hello and welcome to Money Matters. China Evergrande Group is the world's most indebted property developer, owing more than $300 billion to its creditors. Last year, Chinese government officials formed a risk committee to restructure the company. Zella Chin reports on the potential outcome of the restructuring and what that could mean for investors.
The China Evergrande Group was once China's largest property developer. Founded in 1996, nowadays it has over 770 construction projects in more than 230 cities across China. Besides building real estate, it bought a football club, invested in an electric vehicle company, and created theme parks.
Evergrande has been expanding very rapidly over the past few years, and much of the expansion has been relying on debt, basically. So they borrow money whether from banks, from bond issuance, or from other types of financial obligations, including wealth management products.
Yeah, so actually this is a bubble.
Jason Chan is the head of research for this securities firm. He says the entire China property sector had expanded rapidly because of easy credit in the last few years.
The offshore bond market is quite active, and the U.S. interest rate is keeping low, so that most of the developers can issue the offshore bond in Hong Kong at a very low cost. This stimulates them to capture more capital, raise more funds to do the acquisition and buy more land banks in China. And of course, the real demand of the residential property in China is keeping on increasing. And more high-income group, they choose to put their money into the property market.
To minimize the property sector's reliance on debt, Beijing developed the 3 red lines policy in 2020. A 70% ceiling on liabilities to assets, excluding advance proceeds from projects sold on contract. A 100% cap on net debt to equity. Cash to short-term borrowing ratio of at least 1. Failure to meet these red lines would cut off property developers' access to new bank loans. Evergrande failed all 3 red lines.
In the case of Evergrande, because it owes so much debt to bondholders, banks, or other creditors, it's just cannot repay. It has a liquidity issue, it has a solvency issue.
Evergrande's liabilities ballooned to more than $300 billion. It missed several loan and bond payments in 2021. By December, Fitch Ratings declared the developer in default. There were fears that Evergrande's problems could trigger a wider crisis in China's property market and threaten the financial system. A Hong Kong government audit showed that the city's exposure to Evergrande was very minimal, at 0.05% or 14 billion Hong Kong dollars of banking assets. This did not pose a threat to the city's financial stability, said authorities in October. But investors expect to lose a lot of money.
We can see that the offshore bond issued by the Evergrande Group are just trading at around $10 to $20 at the current stage when compared to the face value of $100. That means the investors are now facing around 80 to 90% a loss compared to the face value. And that means the market speculated that this group cannot meet the financial obligation.
And losses aren't limited to financial institutions and professional investors. The share price dropped almost 95% since a high of about $27.10 in July 2020.
Those who bought Evergrande stocks also has a very large loss. Many retail investors or some elderly group also invest in this stock because in the few years you can see this stock can rise from $4 to $5 to $20 and $30. They think this stock is a high potential one.
Home buyers and retail investors in the mainland have been protesting at Evergrande's headquarters, worried that they'll lose their money.
Some of them may buy the flats of Evergrande, so they may take the risk that they cannot get the house in time. And some of them invest in the wealth management products. This wealth management products is not backed up by any body or any assets. So if the group go into a default or bankruptcy, these products may not be fulfilled.
In December, the government of Guangdong province, where Evergrande is headquartered, formed a risk committee to restructure the property developer. The economist Tommy Wu expects the committee to be able to manage Evergrande's problems.
First, to make sure that the construction projects will continue, homes will be built, those who prepaid for their homes will get their home, workers' salaries or wages will get paid. And then it would be suppliers and also some of the retail investors of the investment products. And then perhaps the bondholders, banks, there will be restructuring of repayment schedules, or there will be a haircut or in terms of how much the bondholders would get paid. So they will not get 100% paid. So perhaps something like 20-30%.
The China Evergrande Group owns a few properties and construction projects in Hong Kong. Experts say recently the developer sold its share of this residential property in Cheung Sa Wan to raise cash to pay creditors.
For many different purposes.
Vincent Chung, a property consultant and appraiser, thinks Evergrande is trying to offload its Hong Kong assets quickly.
Compared to the other countries, the liquidity of the real estate in Hong Kong is relatively high. They are trying to liquidate all the, say, sellable assets, no matter onshore or offshore, to repay the debt or to make sure that, say, the construction in progress projects can moving forward.
Reports say the developer is looking for buyers for its Hong Kong headquarters in Wan Chai and residential land in Yuen Long. Besides Evergrande, a number of other mainland property developers, including Kaisa, Fantasia, and Modern Land, have credit problems and also defaulted on their bonds. The sector faces more financial challenges in 2022. In the first quarter, Chinese developers have 210 billion yuan in maturing onshore and offshore bonds. And in the second quarter, 209 billion yuan of maturing bonds, more than the 191 billion yuan in the fourth quarter of 2021. Tommy says that the developers can't meet their financial obligations, then that could cause a deeper downturn in the property sector, slowing China's economic growth. Property and related industries make up almost 25% of China's GDP.
Because with the defaulting of developers, this is going to affect a lot of construction work, a lot of the residential fixed asset investment in mainland China, and also it's dampening housing market sentiment in terms of buyer sentiment.
And adding to the problems, advanced sales of residential homes fell by 17% year-on-year in the second half of 2021. The sales make up about 35% of developers' total funding for the year. Jason Chan has a more optimistic view of the Chinese property debt crisis. He believes the sector would consolidate and stronger state-owned developers would acquire large real estate projects, and their sales would recover by the second half of 2022.
I believe most of the property stocks are trading at a huge discount, let's say 55 to 60% discount compared to the NAV. This valuation is pretty low when compared to the historical average. The government may relax the policy towards the sector, such as to lowering the mortgage rates, to reduce the RRR, and also to stimulate the housing market. It is a good chance for us to capture the healthy property developers, the stocks.
Since the Chinese government is encouraging people to buy property, Vincent thinks that the home sales in the first-tier cities in China will improve this year.
The top-tier cities, their GDP growth is still strong, just like Shenzhen or Shanghai or even Beijing. So the purchasing power of the people are still strong. If the pandemic is to the end, or in case the Chinese economy is recovering, then we expect that the home price will also be growing steadily.
Alibaba is mulling to raise funds for its high-tech grocery chain at a proposed valuation of $10 billion. Freshippo, known as Hema in Chinese, will reportedly kick off the funding round next month. The separate fundraising exercise raises the prospect that Alibaba may spin off the chain as a standalone business. In 2019, Freshippo started off as an internal project, combining a grocery store, restaurant, and delivery app. It uses robotics and facial recognition to speed up logistics and payment. Growth in China sank to 4% over a year earlier in the final 3 months of 2021. Government data showed that was down from the previous quarter's 4.9% and an eye-popping 18.3% in the first 3 months of 2021. The annual rate came in at 8.1%. Forecasters warn weakness will persist this year due to renewed coronavirus outbreaks and a property debt crackdown. That has potential global repercussions, depressing Chinese demand for steel, consumer goods, and other imports. China posted a record trade surplus in 2021 as exports outperformed expectations amid a global pandemic. But analysts are pointing to a slowdown in international shipments in the coming months. China's trade surplus hit nearly $680 billion in 2021, the highest since records started in 1950. China's customs says it was up from $524 billion in 2020. For all of 2021, total exports and imports each soared 30%. Analysts say to maintain the same trade momentum this year could be challenging. Production and shipping already face disruptions as authorities scramble to contain recent Omicron outbreaks. 2022 may bring less global dependence on Chinese production if Southeast Asia recovers from virus outbreaks and ramps up production.
Coming up on Money Matters, a New Year's choice of hot stocks. Stay with us. Welcome back to Money Matters. As we look back at the investment year in 2021, we saw a volatile stock market here in Hong Kong. Starting fresh, we asked our stock-picking analysts what shares they drop into their 2022 portfolios as they go head-to-head.
Joining us for a rematch in 2022 is Francis Lun and Dickie Wong. Veteran Francis says with the tech regulatory crackdown on the mainland dragging valuations lower, his first stock pick is e-commerce platform JD, stock code 9618. He says the Alibaba rival is currently number 2 in sales. Francis says tech shares have crashed while their business practices remain under a watchful eye of regulators, clouding the share's potential for a comeback.
Until the second week of January, and then because of U.S. tech stocks rebound, China tech stocks also rebounded because they have been so really oversold. The valuation gone from something like 100 times PE to something like 15 times PE. That is exactly what happened to JD. And then after reaching 236 recently, and then the stock staged a strong rebound.
JD is the high-hanging fruit of the China tech sector that managed to stay out of the spotlight while Beijing bashed its way through the sector, waging a war of rules and regulations against the bigger low-hanging companies like Alibaba and Tencent. It also joined the club when regulators demanded greater security of its user data and its workers.
Well, because it's not as big as Alibaba and Tencent, so the anti-monopoly measures have not hit JD as the other two leading big techs, so that it has been spared the worst of the correction, while Alibaba and Tencent fell sharply. The fall of JD is much more moderate.
Since Jack Ma's inadvisable speech criticizing the Chinese government's handling of the tech sector in the autumn of 2020, Alibaba shares have dropped over 60%. Using the same timeline, Tencent has lost 40% and JD 30%. Francis says the risk of government interference remains, but feels in 2022 Beijing will decide to lay off.
In 2022, the bureaucrats believe they have done enough. We have not seen any action yet. So I hope it will be the trend in 2022, and then the big tech stocks can rebound to the all-time highs.
Francis sets a target price of $360 and a stop loss of $280. Francis doubles down on the risky share recovery story and dives into another regulatory quagmire, choosing education industry counter Advantage for his second pick, stock code 382. Beijing cracked down on tutoring schools to relieve the financial burden on young parents and the pressure on their kids. That caused considerable collateral damage.
It specializes in post-secondary education in professional schools. So if you finish secondary school, you want a skill in whatever, like home building or electrician, etc., you can go to this school.
The company has a number of campuses in China and Australia, but its prime focus is the Greater Bay Area. Francis says its share price soared to $10, but in the industry maelstrom dropped to a low of $290. He says a partial rebound is only the beginning of the stock's recovery.
I mean, it's just that the stock is really oversold. It's undervalued, and it pays a good dividend, and then it manages to report 30% gain on net profit every year. So it should not be this cheap. So it's buy on the cheap.
And it's kind of gone through all
the trials and tribulations of government intervention.
The risks have come and gone, right?
Yeah, that's right.
Francis says he set a near-term target price of $5.50 and a stop loss of $3.50. Challenging Francis is Dickie Wong of Kingston Securities, whose first pick tracks Francis's logic in the tech sector, Alibaba, stock code 9988. The mammoth loss since 2020 sets the share price up for possibly a colossal rebound. The fundamentals remain sound.
This is the best timing for us to buy Alibaba, because I'm a believer of be greedy when others are fearful. So when others are fearful, this is a good time.
The company's been through the ringer in the last 2 years, but Dickie thinks that set the company up for good things to come. Its forward PE is hovering around 15 times, unheard of for a fast-growing technology company.
We talk about share price or the valuation of so-called new economy style. Alibaba is only trading at a very humble valuation P multiple. So in a longer term perspective, I think Alibaba is a good pick. Even though share price rebounded quite significantly in the past 2 weeks, I think investor may still buy at the level, for instance, like $125.
He'd consider a stock price of around $109 as the very rockiest rock bottom level for the tech giant, even if the regulators don't go away in 2022.
Not disappear, it's continued, but already reflected, especially when we talk about Alibaba and Script were not successful. Its IPO share price plummeted more than 70% last year. This is the right timing for even value investor.
Dickie says considering the company is still backing smaller companies like internet logistics platform Huatongda and its very own high-tech grocery chain Hema, he figures it'll have its mojo back on track soon. He sets a target price of $145 and a stop loss of $117. Dickie's second choice is China Resources Beer, stock code 291.
In terms of China Resources Beer, after the share price's recent pullback, I think technically speaking, it's time for a comeback or rebound. And second of all, I'm quite bullish about the first quarter of the overall, consumer sentiment and also consumer expenditure. When we talk about the CPI data, I think it's still improving, still have room to improve.
The main risk to drinking beer these days is the renewal of strict pandemic measures keeping people inside their homes. The stock is not especially cheap at the moment, but there's been a sharp pullback in the price, and if you're in the middle of a lockdown, beer is sure to be on the list of essentials. Still, that high valuation is a thing to worry about if the pandemic on the mainland gets worse and consumers stop spending for a rainy day.
Obviously, when the market situation or the sentiment get worse, some of the high P multiple stock obviously will get hurt, like China Resources beer, because when we talk about the P multiple, beer stock never go really cheap. But I think after the recent pullback, I can see it, technically speaking, it's time for a technical rebound at least.
Dickey sets a target price of $67 and a stop loss of $53. We'll review Francis and Dickey's stock picks in a month to see who comes back to go head-to-head. Here's one you don't grapple with every day. Camel wrestling, a traditional festival in Western Turkey that attracts thousands of people every year, is drawing criticism from animal rights activists who say the big ruminants are abused and injured during the event. The 40th International Camel Wrestling Festival is held in Selçuk, part of the Aegean province of Izmir, with 152 camels sporting saddles and ornamental clothes and embroidery of various patterns and colors on their humps and necks. Camels are brought into a sandy arena to tangle with each other, with referees and other personnel nearby, and they're made to wear muzzles to prevent bite wounds. Thousands of people set up tables and chairs on a hill adjacent to the arena and cook on barbecues, eat and drink while they watch the animals go at it.
Gerçekten büyük bir suç.
This animal rights activist says forcing animals to fight each other is a terrible crime. But this former head of tourism in the province says the camels cannot seriously hurt each other if they're muzzled. This longtime camel wrangler has 3 spitting fighters in the game. He says the event is done with love. It's not a fight, it's wrestling, just like how humans do it. Without the muzzles, of course.
That's the show. Thanks for watching. Next time on Money Matters, as we approach the Year of the Tiger, what feline fortunes will it bring? See you then. Good night.